Alright, for this video I want to go through a sample form 4797 for the 2023 tax year. And in this example we're going to look at this rental real estate partnership entity that sold its residential rental property during the year. So how do they record the sale and how do they record all the different types of income and gains that need to be recognized? Now the 4797 has 2 pages, so we'll cover both pages. On page 2 here, we've got a lot of information, and I've also added these tapes, these footnotes here, just showing some of the math. So obviously none of these boxes get sent to the IRS, but I've done this for us just so we can help trace some of these numbers a bit better. So this is part of the full 1065, so we'll go over the 4797, the 8825, where we report the rental income and expenses, and then of course the 4797 as well. And then I've also got just 2 slides here covering some background on the different types of gains. So this is slide 1, and then slide 2 have a summary of the different types of income and then the allocations across all the properties. So I'll cover that in more detail as well. So if we start with the first slide here, cover some background on the different types of gains and income that you might have to recognize here. So the first one is a Section 1245 property. So this is personal property, right, used in that trade or business. And when you sell these types of assets, you're going to have depreciation recapture that's taxed as ordinary income. And that's ordinary income to the extent that you've claimed depreciation. And then anything over that is going to be Section 1231 gains. Now, the 1231 gains are preferable, right? These give us kind of the best of both worlds because 1231 gains are long-term, right? So they're taxed at the long-term rates. But if we happen to take a loss on the sale of the property, the losses are ordinary, right? So that is the best of both worlds for us. Now, the personal property that we're going to look at in this example includes things that went into the house, such as appliances, carpets, other fixtures. Those are eligible for bonus depreciation, accelerated depreciation. So we'll see how those items are taxed when the property is sold. Then the second one are the Section 1250 gains. So when we talk about Section 1250 gains, we have to look at the unrecaptured Section 1250 and then Section 1250 recapture. So they sound very similar, but they are quite different. So when we have unrecaptured 1250 gains, we're talking about the depreciation recapture on real property assets where we use straight line depreciation. Now, the Section 1250 gain is a piece of the 1231 gain, and I'll explain more about that later when we look at the numbers. But when we compute the overall 1231 gain, the portion that is attributed to this straight line depreciation of the real property is the 1250 component. Now, Section 1250, unrecaptured 1250 is good because the depreciation capture on those assets, it's subject to these ordinary rates, and it's treated as capital gains, but the maximum tax rate is 25%. And you can use other capital losses to offset 1250 gains. So in contrast, when we look up here for the personal property, when we sell this and we have depreciation recapture, it's all ordinary. So if you're in the top bracket, let's say 38%, you could potentially be paying 38% on that depreciation recapture. With unrecaptured 1250, the maximum rate that you would pay on that depreciation recapture is 25%. All right. And then lastly, we have 1250 recapture. So this applies when we have Section 1250 property that's depreciated at an accelerated rate over the straight line method. So normally we see this with land or building improvements that are, let's say, 15-year property. And so we claim the bonus depreciation or an accelerated makers 150 dB rate. And so if you have, and we'll see this in our example, when we have that kind of depreciation, a portion of the depreciation qualifies for the unrecaptured 1250, but then we also have this ordinary element as well. All right, so let's go through some of these numbers, and then when we'll look at the return, hopefully some of this will make a bit more sense. So in our fact pattern here, we've got the rental company it bought a residential rental property last year, so in 2022 for $1.195 million. And then the purchase price was allocated across all the components. So the building itself, the house, land improvements, and then the personal property components. And then in the current year, 2023, the company sold that property for $1.45 million. So if we look at this chart here, let me explain kind of what we've laid out. So on the top row here, we've got the different types of components that were part of the sale. So the building itself, the land element, the land improvements, and the personal property. Now, the reason why we separate all these out is because, one, we have to allocate the sale price across each item depending on its FMV. And then also each item was subject to different kinds of depreciation rules, right? And so, for example, the land allocation, not a depreciable asset. So we have gain on there over our original costs. Land improvements in the personal property, these were subject to bonus depreciation. So that's certainly treated differently. And then the building is the 27.5-year property depreciated over a straight line method. So we've got the total sale allocation here, $1.45 million, and we've allocated this portion to the building, the land improvements, and then lastly the personal properties for $75K. Now, when we look at the original cost, this is what we originally paid for it, right? The $1.195 million, and this is how it was allocated across the different groups. So we see here on the depreciation line, we've got the depreciation that was claimed, straight line for the building, no depreciation for the land. The land improvements, we took 100% bonus depreciation on those amounts, and then the personal property components, we took bonus depreciation on that as well. So when we look at the adjusted basis here for each item, we've got the cost minus the depreciation. So the building, for example, this net gain is the sale price allocation over the adjusted basis, and this is the net gain for this item. And then we do the same for each. So the land, we're saying we had a $20,000 gain on. Land improvements, because the basis was zero, we've got a $60,000 gain. And then the personal property, because the basis was also zero, because of all that depreciation, we got a $75,000 gain. So when we look at all of this across the board, the total gain on this disposition, this group sale of assets, is $427,368. So the analysis here is now, okay, of this $427,368, how do we break this out into the various components? What's going to be ordinary gain? What's unrecaptured, $1,250? And then what's Section 1231 gain overall, right? So what is that long-term capital gain component? And so I think at this point, let's go have a look at the return itself, and then we'll explain kind of how we arrived at each of these items. So if I go back to the 4797, so if we take a quick look at the balance sheet, just to get a sense of what we had at the start of the year. So we've got the buildings and other depreciable assets, the amount of accumulated depreciation that was claimed on those assets, the non-depreciable land, and we have some loan origination costs here that are being amortized over the life of the loan. Now, because they sold the property and paid off the mortgage early, the loan costs, you can accelerate the amortization. So you can amortize all the remaining amounts, but this amount is not going to be included with the 4797. So when we look at the 4797, the parts that are part of the group sale, we're going to have the land, and then we're going to have the house, the land improvements, and then the other personal property items. So the appliances, carpets, furniture, and etc. All right, so if we start with part one up here. So we sold the property, $1.45 million, and we did receive a 1099-S, so we are reporting the gross sale price there up on line 1A. So $1.45 million was the total sale price for all of this, right? Now, in part one, we report sale or exchange of property that was used in our trader business and held for more than a year, but we also would report stuff up here if it was non-depreciable property. So you notice that in part three, we're reporting all these other items, and the question is often, well, why don't we report the land here too, right? We had a gain on the sale of the land. It's because the land was a non-depreciable asset. So in part one, the first element we report here is the land, the date acquired, the date we sold it. That was our original cost basis, right? The $250,000 that we allocated to the land. And then based on our worksheet here of how we're allocating the sale price, we allocated $270,000 to the land. So we've got $270 minus $250, and we've got a $20,000 gain. Now it's a $20,000 gain. That's going to be included here in the line 7 figure. This amount is ultimately going to be our section 1231 gains. All right, so that's the 1231 gains, assets used in a trade or business, sold after holding it for a long-term holding period. Because we didn't have any depreciation, there's no recapture there, right? Because it is land. Now, if we go on to, so part 2 is where we have the ordinary gains or losses. But you'll notice here we don't report anything on line 10. We report all of these items on part 3, and then the ordinary component flows through here to line 13. So if I go to part 3, each item that is sold as part of that bulk sale needs to be separately stated. So we've got the house, the improvements, the appliances, carpets, and furniture, and then the date acquired and sold are all the same for each. Now, on line 20, the gross sale price, because this is a group sale, again, like the page 1 for the land, we're allocating a portion of that price to each asset based on what we think the fair market value is. So we've assigned $1,045,000 here for the house itself, right, the structure. So that's the $1,045,000. We did $270 for the land. And then we're saying that the piece that is applicable to the improvements is $60,000. So there was a little bit of a depreciation there as well. And then with the internal stuff, the appliances, carpets, and furniture, we allocated a fair market value of $70,000. So initially we had $85,400, but now we think after a year and a half has gone by, some wear and tear and usage, the fair value of these assets is a little lower, so it's $75,000. On line 21, we input that cost or other basis before the depreciation, right? So this was our cost basis for the building, the cost basis for the improvements, and the cost basis for all that other personal property. Line 22 is the depreciation that we claimed on each asset. So the building was depreciated over a straight line, right? Straight line method over a 27.5-year period. So we claimed $41,968 of depreciation. The improvements, 15-year property qualified for bonus depreciation. So we claimed $45,000 of bonus. And then the appliances, carpets, and furniture, section 1245 property also was eligible for bonus. So we claimed $85,400 there. So the net adjusted basis on line 23 is 0 for the 1245 property, 0 for the improvements, and 772,632 for the building. So our total gain here, subtract line 23 from line 20, and we're left with 272,368 for the building, 60K for the improvements, and 75K for those appliances, carpets, and furniture, and other personal property. So on line 25 here, notice it says if this is section 1245 property, complete these rows, right? Well, property A and B are 1250, so we're going to skip those parts for this, and we're going to go on to property C, which is 1245 property. So the depreciation allowed from line 22 is $85,400. Enter the smaller of line 24 or line 25A. The smaller amount is $75,000. So based on this disposition here, $75,000 is going to be ordinary income because this is the depreciation recapture portion. So we took $85,400 of depreciation. The total gain was $75K. So all of that $75K is going to be depreciation recapture, and that's going to be taxed as ordinary income. Now, I'll go to property B last because that's one's a little more complicated. But property A, we skip over this section because it's not 1245 property, and we go down to line 26. Now, if it's 1250 property, and if straight line depreciation was used, enter 0 on line 26G, right, except for a corporation applying section 291. but enter 0 on 26G. So we enter a 0 there, which means we're not required to complete anything here. And that's because this is real property, so Section 1250 property, but we use straight line depreciation, so we can skip this. All right. So ultimately, what this means is the depreciation recapture up there, that's going to be the unrecaptured 1250 gain. And so we'll come back to that later. So the last one, the more complicated one here, is property B, this land improvements piece. So we've got $60K of gain because we depreciated all of it. And so now we need to ask ourselves, okay, well, of that $60K in gain, what is that going to make up of it? Is it ordinary? Is it 1250, 1231? What's the deal? Well, we go down to the 1250 property section, and here we did not use straight line depreciation, so we have to complete this section. So the additional depreciation on line 26A, this is the excess of the depreciation you took, so $45,000, over straight line if you had used that from the beginning. So what we have to do is kind of go back in time and ask ourselves, okay, we had $45,000 of improvements here. Had we used straight line depreciation, how much would that have been? And so if we go back and look at when this was placed into service and calculate the straight line method, we would find that the straight line depreciation that we would have been $4,250. All right, so that's the straight line amount, but we claimed bonus of $45K. So we have $45K of bonus over the straight line that would have been claimed, $4,250. So we have $40,750 of excess depreciation. So we enter the $40,750. We subtract line 26A from line 24, and we're left with $19,250 there. Now, if this is residential rental property, which it is, we can skip lines 26D and 26E. Now, 26D, notice this wouldn't apply anyway because they're asking for additional depreciation after 1969 but before 76. Well, we're talking 2023 here, so that doesn't apply anyway. So on line G, 26G, we have the $40,750 figure. Now, here's what's happening here. We are separating this into a couple of components. So the $40,750, this is the excess depreciation that is going to be ordinary gain. So this is going to be ordinary income plus the $75K up here. So we have $115,750 of ordinary income. Now the portion of this $60,000 gain that's unrecaptured $1,250 is the straight line piece. So we have straight line depreciation on these improvements, which is unrecaptured $1,250. And so if we take the unrecaptured $1,250 here of $4,250 plus the $41,968 from the actual building itself, the total unrecaptured $1,250 gain is going to be $46,218. All right, so I'll come back to that as well, and we'll show where that's reported on the K1. All right, and then the difference between all of that is just going to be that section 1231 amount. All right, so now once we have all these values in place, we can summarize the totals down here in part 3. So on line 30, total gains for all these properties, add columns A through D, line 24. So line 24, the total gain up here, A, B, and C, is $407,368. Line 31, we want to add up lines 25B, 26G, and 27C, 28, and 29, and so on. So 25B is the $75,000 figure, 26G is the $40,750, and we're left with $115,750. So now we subtract those two values, and we're left with line 32 is going to be $291,618. Now, once we have these values, the $115,750 is reported back on page 1 of the 4797 on line 13, and then this value is reported on line 6 of the 4797. So if I scroll back up here, here's our line 6 value, $291,618. And there's our line 13 value, $115,750. All right, so now that all of these numbers, so the 4797 is complete. So now the question is, where does all this end up? So the total gain here, the 311,618, this is our section 1231 gain. So if we go to the K1 for the partnership, distributed share items, line 10, net 1231 gain or loss from the 4797, there's that $311,618. All right, so that's our 1231 gain from the 4797. Now the ordinary gain or loss, the 115,750, because this is a rental property, this amount flows through to the 8825. So if we look at our 8825, rental real estate income and expenses, we've got the activity for the current year there, plus the increase in amortization for the payoff of the note early. And then line 19, we have our net gain or loss, part 2, line 17, from the disposition of this property for rental real estate activity. So there's the 115,750. So this gain gets included with our net rental real estate income or loss. So the 101,751 is ultimately what goes up here to line 2. All right, so that's those two items. Now that we've covered, so we know where the 311,618 goes and the 115,750. The last item is the unrecaptured 1250 gain. So the unrecaptured 1250 gain is again the straight line depreciation on the building, and then the straight line depreciation on the improvements that's within this number, right? So that's the 4250 of straight line improvements that should be included in there. So if we go back to K1, there's our $46,218 figure. All right, so those are the big ones, right? So the ordinary gain is in there, the 1231 gain is on line 10, and then the 46,218, the unrecaptured 1250 is on line 9C. Now it's important to remember that the unrecaptured 1250, this is a piece of the section 1231 gain, right? So if we look at the return, so the 1231 gain, 311,618, plus our ordinary income gain from the 115,750, that is our total overall gain, the 427,368, right? So the 427,368 is the total gain after accounting for the total sale price and then the adjusted bases of each of these pieces of property. So when we look at the Schedule K here, it's not as if you take these two items and then add the unrecaptured 1250, right? That the unrecaptured 1250 is a piece of this Section 1231 gain. That's really important to remember, because I often see a lot of confusion where they're adding the two together and thinking, well, okay, well, this isn't making much sense. How come I have more gain than I actually do? And that's not what's happening here. All right. So once those values are inputted, then ultimately, obviously, this gets transferred through to the Schedule K1 for each partner. So if we look at John's K1, for example, we can see that the ordinary gain or loss isn't a separately stated item here. It's included in line 2, but we can see his allocation of the net 1231 gain and then his allocation of the unrecaptured 1250, which is included in that amount. All right, so that covers it for this video. I hope that was helpful. Any questions, obviously, feel free to leave a comment below, and I always appreciate you watching, and I look forward to seeing you on the next one. Thank you.